Hello, my name is Alan Small. I'm a senior investment advisor with Dundee Wealth. Over the next 10 minutes, I will be presenting ideas that I've been discussing with my clients on how managing their portfolios during volatile times. When times are tough and uncertainty seems to be everywhere, there are investment ideas that individuals may consider that will reduce the risk in their portfolio and help stabilize their portfolios during these volatile times. A strategy of capital preservation is dictated by a portfolio's makeup and how it is being managed. Are your investments being recommended to you based on your risk profile and objectives, or are you just being lumped in with everybody of the same risk tolerance? Are you keeping up with the latest trends in the marketplace, and are you acting on those trends with your portfolio? There are several actions an investor can take with their money to minimize volatility over the long term. I will be discussing a few of those today. First, you want to look to leaders. These are companies that are leaders in their field, leaders in their sector. We call them best in class. These companies tend to be large cap or large in size. They tend to insulate investors when times are difficult and the market is volatile, and they also tend to be the companies that will move higher when times get better again. Second, you want to get paid to wait. Investments that pay a dividend while you wait for the growth tend to outperform in the long term versus ones that do not pay a dividend. There are many investments today that can pay you 4, 5, or as much as 6% while you wait for the growth to come later on. First illustration, which discusses the S&P 500 dividend contribution to total return. As you can see, that over the last 80 years, dividends have made up 53.8% of the total return for the S&P 500. There are some years where it actually makes up 77%, 76%. So one could see that dividends is a huge part of an investor's total return. The second illustration shows the difference between non-dividend payers and dividend payers, as well as dividend growers over the last 24 to 25 years. You can clearly see that non-dividend payers would have given you a rate of return of 2.2%, whereas dividend-paying investments would pay you on average about 10.7%, whereas dividend growers, which are companies that continuously grow dividends over time, a little different than dividend payers, would give you a rate of return of 12.5%. A very large difference. And again, just clearly shows that dividend-paying investments outperform over the long term. Number 3, shop for bargains. Many smart investors look for companies that are cheap, trading at very low multiples. A lot of investors look to the PE ratio. P, which stands for the price per share of that corporation, and the E stands for the earnings per share. If you have a price of a stock that is trading at $10 and the earnings per share of $2, then that PE multiple would be 5. From a historical perspective, anything less than 10 usually means the company is fairly cheap. However, one cannot only go by that. You would have to look at the different companies in the sector, peer group, competitors, to see how they all fare with respect to the earnings multiples. I have a few illustrations today which clearly shows the relationship between the PE ratio of the broader index, the S&P 500, and stock performance, or the index performance. As you can see, in 2000, as an example, PEs were off the charts, up to about 45. That coincided with the tech boom that we saw in the early part of the last decade. Unfortunately, we can see quickly how fast PE ratio fell as the stock market started to fall with it. The average over the last 100 years or so for the PE for the S&P 500 is about 16. Putting that into perspective, today the PE ratio for the S&P 500, October 2011, is about 12 or 13. So right now, many individual investors believe that the stock market will move higher and PEs will get back closer to their averages. Second illustration compares the PE ratio to interest rates. As you can see, when long-term interest rates are high, PE ratios tend to be low. And when interest rates are low, PEs tend to be quite high. However, today, with interest rates at record lows, the PE is still very low, which again leads to the point that many are making that eventually the stock market should rise in relation to historical PE levels and long-term interest rates. Lastly, reduce costs of investing. If your portfolio is large enough, you can have your own specifically tailored mutual fund built for you out of individual securities in a fee-based scenario. Fee-based accounts tend to be cheaper than managed products such as mutual funds, and in many instances, these fees are tax deductible. This is just another way to keep more money in your pocket during difficult and volatile times. In summary, when the market is volatile and uncertainty seems to be everywhere, I believe you want to look to large corporations, leaders in their sector, best-in-class companies to invest in. If you could find these companies, and if they were to pay you a dividend while you wait for the uncertainty to clear, that would be the best scenario. And on top of that, if you can purchase these companies at cheap valuations using the PE ratio as your guide, that to me is the recipe for success going forward. If you have any questions regarding navigating your portfolio during uncertain times, send me an email or visit my website at www.investmentadvisorgta.com. I'd be happy to speak with you. Thanks for watching.